Jhonsa Jones, lead analyst, metal and mining, and he represents Anand Rathi Institutional Equities. Good morning, nice to have you on ET Now. What do you make of the current setup for the metals? One side, higher duty on copper. Other side, nothing so far on steel. Too much of yes, no, I don't know, yes, no, I don't know is happening.
Hi, good morning. Thank you for having me. Absolutely, yes. The copper duty, which was expected to be about 25, is now at 50. So there is a lot of confusion happening in the global landscape. As far as copper is concerned, the ore crunch is going to be there. The prices are expected to remain elevated at least over next 1.5, 2 years. So there is no doubt that the prices are going to remain high over next couple of quarters as well, till the time this ore crunch does not settle down on a global landscape.
Uh, what are your thoughts on the underlying demand with so much of back and forth? One day it is olive branch from Donald Trump, next day it's Iron Fist, then it is olive branch again, then it is Iron Fist. How does one go about planning things if you are a metal manufacturer or if you're a metal company? And metal is one of those, one of the sectors where it takes 3 to 5 years to identify the mine and then build capacity. What happens to the new and existing capacities now?
Let me just put it across. Copper usually takes way more than 3 to 5 years. Ideally, globally, a copper mine. So from the time you identify resources till the time you would basically pull out the material from the mine, the average global timeline is about 12 to 14 years, bare minimum, right? You rightly pointed out it takes some time for a particular copper mine to come up on stream. However, when you talk about demand, the demand is extremely strong. If you see last year, there was some deficit in primary copper. When you talk about primary and secondary copper put together, the global was matching, right? However, a couple of years down the line, there will be a deficit of almost about 3.5 million tons when you talk about primary and secondary copper both put together, right? Now the demand is coming from all the new age sectors, whether it be renewables, semiconductors, main is electric vehicles. All these things are going to keep the demand elevated, not just in next 1 or 2 years, but a couple of years even down the line, right? So by the time you hit 2030, 32, 33, there will be a deficit in copper. This is as far as copper is concerned. When you talk about other metals, the same scenario is also seen in other metals. The ore crunch might not be as bad as copper, but the demand for aluminum is also expected to keep on growing. The demand for stainless steel, the demand for steel, and especially demand for steel in countries like India, which is growing, is expected to keep on rebounding from here on.
So that's the take coming in on the copper. But Parthiv also talked to us about the steel prices, because back home we have seen, because all of those safeguard duties kicking in, there has been some bit of a resilience, or rather an uptick on the steel prices. How do you see the demand shaping up, as well as what's your thought on the steel prices? Because on a sequential basis, I believe they've already seen an uptick of 7%.
Right. Just to first talk about the demand, if you see the quarter one, production was almost up about 10%. The demand is up about 8%. So you are almost at around 40 million ton kind of a quarterly, consumption in India, right? As far as the prices are concerned, the prices definitely after the safeguard duty, the flat steel prices went up. They touched about 51,000. However, because of the early monsoons, there was a substantial reduction in the price for the long steel, right? Especially in the in the last month, last 15, 20 days of the last month, right? So now, over last 4, 5 quarters, what longs used to come under premium to flats, now they're almost on par with each other. However, globally things have been shaping for good. For example, yesterday and today, Bao Steel in China has actually hiked its price by about 14, $15. That's about 3.5%. Plus, there are multiple measures being taken in China where it's expected that the other mills will also follow the same price hike for the August delivery as Bao has done, right? These whole things is expected to again revive the prices over 51,000 rupees over the next couple of weeks, even in India. So, we expect about 2 or 3% kind of a price hike once things get normalized.
Parthiv, now talking about the steel exports, they have turned positive in June as we see the statistics and data. So do you see the trend sustaining given the global demand conditions, and at the same time, on a macro front, seeing the development of the sector and also the macro development in China, and on the tariff and interest rate front, how do you see this sector from an investment perspective?
Let me first answer the import and export, match. Right, for the first time after many many months, we have become a net exporter. I think we did about 18,000 tons of a net export of steel last month. So that's a good sign. The other thing is because of the safeguard duty, your overall quantum of imports has come down. If you see the quarter one last year, it was almost about 0.6 million ton of a net imports what we did. This time it's around 0.2 million ton of net imports what we did in the first 3 months, right? So that's a positive sign. As far as globally is concerned, as I told you, there are multiple good things happening in China. Number one, they are basically curbing down their overcapacity and everything. There are news that they'll be putting some more stimulus in the real estate sector, though that should keep the demand elevated even in their domestic in their domestic terrain, right? Overall, I think as far as our export is concerned, the major kicker will be the revival or increase in demand from Europe, because one of the largest geographies for India for export is Europe, right? So once things go better in Europe, our exports should pick up post monsoons.
So after that hum and drum, what we saw in Vedanta earlier this week, and I'm not getting to specifics of that report, Vedanta fell. Did you advise your clients to buy into Vedanta? Because I mean the dividend deal is still intact.
Sir, sorry, I won't be able to comment on Vedanta because we do not have that stock under our coverage as on date.
Okay, appreciate that. So which are the stocks which are under your active coverage within the metal basket?
So we have about 10 companies under our active coverage. Four ferrous, which is your Tata, JSW, GSPL, Steel Authority. Then we have Hindalco, Moil, Bansal Wires, Lloyds, and so on and so forth. So as on date, we have almost what a good 10 companies under our active coverage across mining, non-ferrous, ferrous, and the other categories.
When you have to differentiate between, let's say, SAIL and Tata Steel, what is the differentiating point? And we differentiate JSPL and SAIL. How do you figure out? Because ultimately they both are metals, and the color of metal is always same.
I agree that the color of metal is always same, but the shine always differs, right? So let me just put it across. As far as your quarter one, if you want to talk about, then quarter one, I think every company should see at least what good 2,500 kind of a good increase in your realization across all the four ferrous pack. However, what has happened is because, as I told you, there was some reduction in the pricing in the month of June, and also, coal did not fall as it was anticipated to be. It might not completely percolate down to your EBITDA per ton. So, EBITDA per ton, you can expect for all the four companies in the range of about 1,500 to 2,200 kind of a range between all the four entities, right? As far as your Tata is concerned, just to get back, Tata always domestic business is always better, doing really performing better than the global business for Tata, right? So I think, but however, this time around, Tata Europe is expected to be break even, so that is a positive sign as far as Tata is concerned.
Lastly, Parthiv, talk to us about the impact of the coking coal prices as well, because they usually get reflected with a lag, and the coking coal prices were actually flat in Q1 while the iron prices did fell. Help us understand, how do you see the spread shaping up?
So see, at the end of the day, because of the four, especially Tata and Steel Authority are like captive iron ore miners, and of course, JSW has some portion of captive association to it, right? So it's always coking coal which moves the needle at the end of the day. Coking coal was about 198, $199 dollars, and it was flat or between Q4 and Q1, which was actually expected to go down by about, and all the companies had guided that, on the consumption basis, they are expected to go down by about 10 odd dollars. So that not going down, that is why I said the complete increase in ASP of about 2,500 rupees has not completely percolated down because the coal did not go down as it was expected to go down.
Well, thank you so much for all of those analysis and giving your views on the market, and in particular for the metal and steel sector. Have a nice day to you and a great weekend.
Thank you. Same to you.